Hey everybody, welcome back to Whiteboard Finance. The market is pricing in a recession. Dramatic introduction. Over the last 11 weeks, the 10-year note has dropped 65 basis points. What that means is 0.65% in fancy finance terms. So this is not a small move. That's a massive reversal. But here's the kicker. Inflation is rising at the same time. The 1-month and 3-month annualized inflation metrics, they're over 4%. So let me repeat that. Rates are falling. Look at this screenshot right here. While inflation is rising. That doesn't normally happen unless something is really off or breaking under the surface. Let's take a look. So if you've been following my channel, we've been talking about the trade war and we've been talking about market tops. So let's review this. So this is the 10-year Treasury note yield. If you guys aren't familiar with the 10-year Treasury, this is probably one of the most important things in finance because it affects a lot of different things. One of those things being mortgage rates, okay? So let's take a look at this. So the stock market peaks. This is beginning of March on the left side of my screen. You can see the dates on the bottom there. Then we have the trade war escalating. We have the little relief rally, okay, because there wasn't, a lot of comments or headlines or anything like that going on in the news. And then you have the interview with Maria, which I have in my previous videos, Trump saying that he's not watching the markets. You can start to see that S&P 500 enters correction territory, and then we have those 25% auto tariffs being implemented. And at the time of this recording, today is Liberation Day. Some guy last video was like, take it easy with the sound effects. I pressed it like twice, dude. Here, there's another one, okay? So let's rewind this a little bit. So at the start of Trump's trade war, this coincided with the top in the 10-year note, okay? So fast forward to today, we've seen rates falling again as the market prices in a recession. That 25% auto tariff announcement marked the most recent lower high in yields, and now the dominoes are starting to fall. So let's take a look at this chart. This looks a little bit complicated and it looks a little bit intimidating, but stick with me here because it's pretty important, okay? So following the March 13th relief rally, the S&P 500 was only down about 6% from its peak. Historically, when we see stocks dropping an additional 5% at that point, the U.S. was already in a quote-unquote recession. As of Monday, the S&P hit minus 11%. So now here's some historical context. 56% of corrections didn't lead to a recession, but 32% of the time they did within 12 months, and we're already seeing weakness. Okay, so take a look at this chart right here. So the red line is the S&P 500 and what it's doing. So you can see where the S&P 500 is right now. The source here is Bloomberg Macro Bond. And then the black line is the median S&P 500 after 10% drawdowns that do not coincide with the recession. So let me repeat that. S&P 500, the median percentage after it does not coincide with the recession, typically goes up and to the right. That's the black line. The light blue line is the median S&P after 10% drawdowns that do coincide with a recession back to 1969. So you can see that right here. So basically what this is saying is that we're at a crossroads, okay? Are we going up or are we going down? It depends on if we're going to be in a recession here or not. So to back up what I just said, corrections and recessions, 44% have crossed over with each other within a year, 56% haven't. So the 12% is recession started within the past 12 months. The second bar right here is recession started within the next 12 months. And then you can see right here, no recession within a year. So since rate cuts began in September 2024, the S&P 500 is actually down 2%. That's important because historically when the Fed cuts rates during a recession, the S&P 500 drops 6% in 6 months, 10% within 12 months. And you can see that right here. So here's 0, 3, 6, 9, 12 where my cursor is. And you can see right now where we're at in the red circle. So the average post-pivot return is just 1% in 6 months. So this isn't your typical Fed pivot rally. So take a look at this chart right here, you guys. Yellow is the current price. You can see light blue is the average not followed by a recession. You can see the blue is the 7-episode average. And then the gray line is the average followed by a recession. You can see right here, that's negative 15-ish%. Okay, so I'm not going to get political here, but let's call a spade a spade. On March 9th, Trump literally said, in quotes, You can't watch the stock market. I talked about that in this video right here. I even had a video clip in that video.
Before you came into the Oval Office the first time, you were a very successful businessman, very successful real estate executive. And a lot of people said, oh, this is the business president. This is it. He's watching the stock market. He knows all about, he doesn't want the market to go down. And now we've got tariffs and the market has been going down.
Well, not much. I mean, in all fairness,
you said, look, we're going to have a disruption, but we're okay with that. Is that what you meant? The stock market going down was the disruption? What other disruption were you alluding to?
Look, what I have to do is build a strong country. You can't really watch the stock market. If you look at China, they have a 100-year perspective.
To me, that's a tell, okay? And again, I'm not trying to get political. No matter what I say, someone's going to label me something based on a 3-word sentence, whether I say 1 + 1 is 2, the grass is green, the sky is blue. Trump wants lower interest rates and he wants lower inflation. Both are key campaign slogans or promises, if you will. So what's the fastest way to force both down? You guessed it, a recession, okay? He's also promised lower energy prices. Since his inauguration, oil is down more than $10 a barrel. Lower demand, lower oil, that is recessionary. Take a look at this chart. So if you look at this chart right here, Trump is inaugurated. He calls on OPEC Plus to lower oil prices. The trade war begins right in the beginning of February. The U.S. stock market tops, and then oil prices during this whole time are down about 20% in just 2 months. So the Atlanta Fed just revised Q1 2025 GDP to negative 0.5%. And when you factor in gold trade adjustments, it's negative 2.8%. That's GDP contraction, and it's the first since 2022. And here's another signal. Gold is up 70% since October of 2023. It's hit 52 all-time highs in just 12 months. Yes, let me repeat that. 52 all-time highs in 12 months. This has never happened outside of economic weakness. Meanwhile, consumer sentiment has collapsed, which I showed you the last couple of videos, hitting lows since we haven't seen since 2022. So that's the consumer sentiment. This is the University of Michigan. But I wanted to talk about this very quickly. This is interesting. So if we take a look at this chart right here, this is the evolution of Atlanta Fed GDP Now real GDP estimates for 2025 Q1. So if you look at the quarterly percentage change, you can look at this chart right here, and that's pretty much this green line right here. So if we move forward, you can see that the 2-month rolling gold deliveries are now 3.5 times higher than April 2020. This is prompting physical gold shortage. Pretty interesting. So you're probably wondering, what's the point of this video? Because there's opportunity and chaos, okay? In all my videos, I try and actually give you some actionable advice, okay? So we're in uncertain times, but these times are also profitable if you're prepared. So historically, 5 quarters of uncertainty leads to negative 1.5% in GDP contraction. We're already 1 quarter into this trade war. Now is the time to get educated, get strategic, and protect and even grow your wealth. So take a look at this. The longer uncertainty stays elevated, the bigger is the downside risk to the economy. So if you look at the header here, this is the response of real GDP to economic policy uncertainty shock. So this blue line, I know it's kind of hard to tell. You may have to watch this on a TV or turn your device sideways into landscape mode, not portrait mode. Make the screen as big as possible. This blue line is a temporary shock. This green line is permanent shock. And we can see the number of quarters at the bottom of the screen. So if we're at 5 quarters, that's 1.5% right here. You can see on this y-axis the percentage change in GDP, okay? And the longer it goes, it typically goes up and to the right. So again, we're just 1 quarter into this, but we'll see how everything pans out here. I don't have a crystal ball. So if you found this video helpful, hit the like button, smash it. I'm just kidding. Gently click the like button, gently click subscribe, gently click the bell so you get all the notifications from my channel. I'm trying to incorporate a lot more current events, macro, stuff like that. It's fun for me. If you don't like it, I apologize. But I enjoy making these videos. I enjoy the charts. I enjoy just backing up some of these. Like, they're not even narratives. It's just based on what I'm seeing online. So stay disciplined, stay invested. As always, guys, thanks for watching and have a prosperous... let me try doing a Trump voice. I watch Marko Whiteboard Finance. No, that's terrible. Hold on. I haven't really practiced this. I watch Marko Whiteboard Finance, and let me tell you, he's the best. He's always got the best analysis. He's always... No, it's too nasally. Hold on. I need to be more like, okay, New York real estate developer. Okay. I'm talking to the head of a union. Okay. Marko, he's got the best analysis. I really like his channel. He's got the best. We have the best. Dude, you remember on May 5th, in his first term, he's talking about building the wall. And then he goes on Cinco de Mayo, he's like, Trump Tower, we have the best, what was it, burrito bowls? We have the best taco salads. That was so funny. Yes, he's funny. Stop. Okay, relax. All right, guys, all joking aside, thank you. And have a prosperous day, okay?